Our next investment criteria is quite strange, it's quite funny. It's a payback period, okay, payback period. And the funny thing about it, right, the funny thing about it is, remember at the beginning, when we talked about the features for a good method of analyzing investment projects. One of those features is that we should consider all of the cash flows, right? If the factory is going to generate cash flows over the next 30 years, I do want to take into account the cash flows of all of those 30 years. Why should I only look at the first 5 years and ignore the rest of the 25 years? But funny enough, that's what the payback period does, okay? It only calculates how long does it take to get the money back, and doesn't care about any of the rest of the cash flows. So let's say, for example, I need to spend 100 million right now to build those 2 factories in Vietnam. And over the next 30 years, they're going to generate $1 billion for me. Of course, in future dollars. So when you discount that in today's dollars, that's going to be, I don't know, instead of $1 billion, that's going to be $500 million, let's say. Still a very profitable investment. But what payback period does, our next subtopic, is that it only calculates how long does it take to get that original 100 million back. To get the original 100 million back. And it doesn't care about the rest of the most of the $1 billion left in all of the future, more distant future cash flows. Okay, so that's kind of funny there. Where is it? Here. So it just tells us how long does it take to get the money back, a regional investment. Okay. How long does it take to get the original $100 million back? Or how long does it take to get the original $165,000 back? So the answer for this method is not dollars. The answer is how long does it take? So the answer is time. In this case, it's 2.34 years in this particular example. Let's have a look at how do we arrive at this answer. So we're going to look at the same example here. Okay, so we're going to look at this same example and calculate payback period. So payback period, the answer is going to be time. Shows how long it takes to recover the original cost. And remember, we just compare apples with oranges here. We don't even compare apples with apples. We don't even discount future cash flows. So to calculate the payback period, we want to have these 2 columns and we want to have a third column. Let me call it left to recover. This column is going to show me how much money is still left to recover after a given number of years, right? At the beginning, when I spent my $165,000, I still have $165,000 to recover. Wait, I still have $165,000 to recover. By the end of the first year, I've recovered $63,120 out of the original $165,000. So I will have another $102,000 or so to recover. So for the rest of the columns, I'm gonna hit equals this number minus this number, enter. This will show me how much I still have to recover by the end of the first year, how much I still have to recover by the end of the second year, and keep going, how much I still have to recover by the end of the third year, fourth year, fifth year, and so on. And copy it only until you see a negative number. A negative number means that you've already recovered all of your money and even got some more back. But this particular method doesn't take into account any of the future cash flows, even if we had a longer period over here, not the 80,000 by the end of 4 years, this particular method, the payback period, doesn't take into account any of the future cash flows. Only how long does it take to get my money back. So once I see negative numbers here, just delete it. Just delete it. And what does this tell me so far? It tells me that by the end of the second year, so what I need to look at is the last number that I haven't deleted, the last positive number. And I need to look at which year does it show. It shows year number 2. So by the end of the second year, I still have 31,000 to recover, right? But the third year, the next year, recovers more than that. So I don't need that whole third year to recover only 31,000. I only need a fraction of this third year to recover the remaining 31,000. How much is that fraction? What I need to do is take this last positive number and divide it by the cash flow of the next year. So it's going to be equals this divided by this. So I'm going to need that fraction of the next year plus these 2 years. So the answer is going to be this last year for the last positive number plus this fraction. Okay, so it's going to be 2.34124 years. Okay. And for your exams, you don't need to convert this into the number of months and days. So if you have something like this, please don't convert it into 2 years. Let's say 4 months and 3 weeks and 2 days, something. Don't need to do that. Okay, just keep it as it is. That is all. Very easy. Payback period. Let's just have a look at one more example, just to make sure you guys understand everything. Let's change numbers here. Say we have a longer project expected to last for 7 years. Cash flows, say original investment of 100,000. And the future cash flows after that is, I don't know, let's say anywhere between 20,000 and say 40,000. Bam, there it is. Okay, let's Control C, Control V, so it's not a formula anymore. Oh, it's still a formula. Control C, right click as numbers. Now these are numbers, not a formula. Let's say we have a couple of questions. How much is payback period? If, let's say, preset period is, say, 5 years. So let's say you borrow $100,000 from your parents to open your business. The problem is, the parents are going to buy a house 5 years later. So they're definitely going to need that $100,000 5 years later. No matter what's happening with your business, you got to pay back in 5 years. Right? So even if it's an amazing idea, even if after 7 years it's going to give you billions and billions of dollars, doesn't matter. After 5 years, you got to pay this back. I got to pay back 100,000. Okay. So if it takes more than 5 years to get those billions and billions, unfortunately, you cannot accept this project. So that's where the payback period could be useful, when you have a hard line on when you're going to pay back. Okay, so let's calculate the actual payback period and see if we can return the money in 5 years. Okay, so left to return. So here we have full 100,000. Then we subtract the cash flows of the subsequent years. Copy, delete all the negative numbers. Point here. So it takes 3 years and something. So what is that something? It's going to be another 78% of a year. So it's going to be 3.783 years. That's what payback period is equal to. Okay, accept or reject? Accept, because payback period is less than 5 years. There it is. So the decision rule for the payback period, the decision rule of that payback period is we accept if it's less than some given other period, a preset period, a preset limit. We see here a preset period for you by the parents was 5 years. Gotta pay back in 5 years. Okay. Let's change it a little bit. Let's turn this to 10,000. Let's turn this also to 10,000. Let's turn this also to 10,000. And maybe over here we're gonna have 120,000. So clearly, generally, it's a good investment project. Of course, it still depends on the discount rate. We don't even have a discount rate here. We should calculate NPV, but if a discount rate is not really outrageously high, this seems to be a good investment project. But let's calculate the payback period. You see, even 5 years is not enough to pay back. In this second example, our payback period is going to be 5 years and something. What is that and something? This over this is going to be, payback period is going to be 5.15 years. So even though later, during year 7, you get a lot of cash flow from this project, unfortunately you cannot accept it because it takes longer than 5 years to pay back, but you must pay back in 5 years. Let's think a little bit about the payback period. Is it great? Is it as great as NPV? Does it, for example, take into account risk? Does it take into account the risk level of the investment project? Does the payback period take into account different risk level? Like if I go to Japan with this factory, the minimum requirement is only 8%. If I go to Venezuela, minimum requirement is maybe 50%. Otherwise, I'm not going to go there. Does the payback period take into account any kind of minimum requirements on the risk level? So this one is really, really funny because this one doesn't take into account any level of risk. It doesn't take into account the time value of money. We don't do the discounting, and it doesn't even take into account all the future cash flows. It only takes into account enough cash flows to pay back, just like in our 7-year example. Even if after 7 years you get billions and billions back, it doesn't matter. If you can't pay back in 5 years, that's all that matters. So this one is a bit funny. Very good. Let's continue with 1 or 2 more. It depends on how we progress, how fast we progress. Let's see how much we can cover. At least 1 or maybe even 2 more. Next one is average accounting return. Average accounting return, which is simply, as you see over here, a ratio of average net income over the years divided by the average book value over those years. Okay, so let's have a look at this same example. There it is. So let's have a couple of questions. Average accounting return. How much is average accounting return? So let's say we have this business idea, only expected to last for 3 years. And let's say we want to have a look at the average accounting return and decide whether we accept the project or reject the project. And according to the boss, maybe you're a financial analyst in the company and the boss only wants to accept it if it's at least a 20% average accounting return, 20% or more. Okay, So again, as we see, even before we start discussing this, the decision whether to accept or reject, just like with the payback period, will depend on some kind of preset requirement. Okay, it doesn't come inside the calculation. So let's calculate average net income clearly. So same example, two questions. Firstly, calculate average accounting return. Secondly, decide, do we accept or reject? How do we decide? Well, maybe the boss wants at least 20% average accounting return, otherwise we don't accept. So what I've said, I'm just repeating so that we see what we're talking about. Decision whether to accept or reject based on the average accounting return, again, depends on some preset requirement. In this case, by the boss, by the exam question, whatever. This 20% doesn't actually go into the calculations. So it's more like payback period rather than NPV. Okay, so let's calculate average net income. It's going to be the three levels of net income for the next 3 years, 13,620 plus 3,300 plus 29,100. All of that simply divided by the number of years, that's 3. That's average net income. Average book value of assets, that's average book value of assets. We already have it, in this case 72,000. So in our case, average accounting return is this divided by this. Okay. In our case, average accounting return is 21.3%, except as average accounting return is greater than 20%. Okay. Actually, based on this question, at least 20%, it means greater or more. So it depends on the question. Maybe the boss wants at least 20%, or maybe the boss wants greater than 20%. If greater than 20%, let me rephrase it so that we all are on the same page. If it says over 20, then the explanation here is like that. Okay. Let's have a look at another example. This one is a bit too simple, maybe. So another example, let me scroll down. Say your business project has the following expected profits. Remember, profit is another word for net income, right? So years 1, 2, 3, 4. We don't need 0 here because the profit is going to be not right now. How can you have profit right now? For profit, you need to have the business operating. So there is no 0. You can have investment right now. You can start spending money right now. But to generate profit, you need some time. So whatever are the numbers, let's have some random numbers there. Random between 10,000 and let's say 20,000, whatever it is. Let's have a longer project. Say something like that. These are numbers now, not formulas. And let's say book value at the start is equal to 98,000. Let's say book value at the end is equal to, let's say, for example, 18,000. Depreciation. But let's say it's a straight line depreciation. Remember from accounting classes, there is like sometimes accelerated depreciation or there is straight line depreciation. So this sort of calculation only works with straight line depreciation. It doesn't work with accelerated depreciation. So in a straight line depreciation, book value goes down in a straight line from 98,000 down to 18,000, right? So over this time horizon of 7 years, the book value is just going to go like this in a straight line from 98,000 down to 18,000 in a straight line, meaning that the average is definitely going to be just in the middle, not anywhere else. So only for straight line depreciation, average book value is 98 plus 18 divided by 2, which is $58,000. Okay, and let's say boss wants at over 13% of average accounting return. Do we accept it or reject it? And first is how much is the average accounting return? So let's have average net profits equals average. These are the net profits. By the way, I forgot to name this column. Let's call these are net income. Profits on net income. So average accounting return is going to be equal to equals this divided by this. That's 25.6%. That's greater than 13%. Strictly greater because boss wants over. Hence, accept. Right? If we change the numbers a little bit, let's say this is only down to 78,000. Let's see what happens. This turns to 88. Our rate is still 16%. Let's reduce some of the numbers. There it is. Now we reject. Now we reject because average accounting return is not greater than 13%. Right? Oh, discussing the average accounting return. Does it take into account the time value of money? Does it take into account the time value of money? The future dollars versus today's dollars, are we like comparing, are we converting everything into today's dollars here? No, we didn't convert anything into today's dollars. So all of the future net incomes for the 7 years example in that Excel example, we didn't do anything with that. We just take average of that. So this is also pretty simple. We're actually, when looking at the dollars, we're comparing future dollars with today's dollars. So we're actually comparing apples with oranges.